I think the joke goes that Jimmy Buffett or Warren Buffett, neither of them have a crystal ball into what the future of the economy looks like. That being said, it is something we should try to understand as well as possible and prepare for all eventualities to the extent that we can. Therefore, you really want to know what you know, you want to know what you don't know, and to the extent possible, even know some of those unknown unknowns. So to that effect, I wanted to share some of our thoughts, observations, and experience from 2023 going into 2024 as we look forward into the middle market and lower middle market capital markets and M&A environment. What are we seeing? How are we feeling? What's the sentiment that we're picking up from the hundreds of conversations we're having every week? So from the capital markets perspective, although there may be some cut in interest rates in 2024, I would not expect it to go down materially. I do expect that we are going to be in a not stagflationary environment, however, an environment that interest rates are going to remain high for a prolonged period of time. Whether there's a soft landing, hard landing, that's the part that's going to be very difficult for anyone to accurately predict. But that being said, expect interest rates to stay higher. Even if they come down from, say, the 8% range for a corporate loan, I wouldn't expect them to get beneath 6%. And so something to keep in mind, the cost of capital from traditional lenders and non-traditional lenders will remain high. And we say high in quotations because to some extent it is a reversion to historical norms. And so it may just be more normal than it had been from, call it 2019 to 2022. Secondly, from a capital perspective, expect the buckets of haves and have-nots from a traditional banking perspective to stay somewhat pickier than it had been a few years ago. And what we mean by this is that although the bank lending rates may oscillate, we still expect banks to be very risk averse, really keep an eye on their existing portfolios. Obviously, the shutdowns of the banks that we saw over the last couple of years has certainly had some ripple effects in the market. And so while banks will still lend on situations that warrant it, we still think they're going to be more selective, particularly within corporate loans that are more cash flow driven with less collateralized types of situations. And lastly, I'd say we're going to continue to see the proliferation of non-bank lenders. And so we've seen a lot of them put money together over the last few years and become more and more active, and they're becoming more and more competitive. Again, I always say you can have things good, fast, and cheap. A lot of these lenders are able to provide the solutions that are good, that are necessary on an expedited timeline, although the lending rate is not going to be as cheap as the bank. Now, that being said, don't get the misconception that your only options are loan sharks and traditional banks. There is a lot in between, particularly in the middle market, and now in the lower middle market. That private credit lending space has really evolved over the last 5 years. We expect to see that shining particularly within 2024, as they are stepping into a lot of situations that perhaps the banks would have taken on a couple of years ago, but are right on that fringe. So now pivoting over to the M&A side, or the business exit and sales side, we still think that the IPO market and the exit market or liquidation monetization market for early stage companies is going to be relatively anemic. A lot of these companies have raised money at valuations that they are now raising money at lower valuations, so to exit the business is not going to make sense for them. And likewise, the public markets are not nearly as frothy as they were for early stage companies. Again, is this a reversion to the norm? Is this just a feeding frenzy that there's no more food left? To be determined, but I wouldn't expect to see some of the dizzying heights for sure for some time to come. So now on the other end of the spectrum, talking about the mega deals, the large mergers, the multi-billion-dollar deals, what we're seeing there is a bit of a bid-ask spread. And what we mean by that is that there's gigantic companies who believe they are worth what they were worth on paper or by the market, the voting machine, not the weighing machine, perhaps a couple years ago, when in reality, those valuations are now coming back to, again, historical norms and multiples as well. And so while you're seeing strategic situations happen where someone's looking to buy access, to buy capabilities at an elevated price, many of the mega deals are reverting back to some means, and by virtue of that, I think what people are willing to pay for these companies and what people are willing to sell for these companies is broadening to some degree. However, you do see at a certain point that this kind of snaps back into line when people say, look, well, we have to transact one way or the other. I would expect that to happen. Perhaps people can still wait things out in 2024, but we'll see. And so lastly, in the area that we primarily focus in, which is middle market and lower middle market transactions, tends to be transactions of $1 to $200 million, $1 to $10 million in EBITDA, sometimes bigger. Within that space, we can confidently say from our experience over the last year or the last 24 months that there is just more and more momentum, that market remains incredibly active for a few reasons. One, there's a tremendous amount of dry powder. And when people say that, they mean that funds, whether private equity funds, whether corp dev groups that have had allocations from their corporate treasury departments, there's a lot of money sitting on the sidelines looking to do deals. Secondly, think from a risk allocation. If a company or a private equity firm is looking to buy a business, what has more risk? The upstart company that may or may not be something exceptional, or the tried and true business that makes profit every single year. Now you could say, well, they're not gigantic companies, but at the same time, if a financial buyer or a strategic buyer in a market where the future is not certain is looking to make an acquisition, would they rather take financial risk or would they rather take execution risk? That being, would they rather buy something that they're not sure if it's even good, or would they rather buy something where if they had a concern, it would be, can we integrate this? Can we make sure that we can do this efficiently and expeditiously, given that it's not a $500 million, $1 billion transaction? And I can tell you from our experience over the last few months in particular, they would far rather have the latter. Remember, the hardest thing in the world is to create EBITDA, and a good company that creates EBITDA will have tremendous value. And lastly, relative to the middle market M&A and lower middle market M&As, we'd say we're seeing lots of deals happen that have no leverage. And what we mean by that is that the buyer is not using debt to make the acquisition, but is purely using cash equity. Right? If you buy a company at 8 times EBITDA, you're still implying a double-digit EBITDA return. And so that spread over what someone could get over on a treasury bond or a riskless asset, if you will, is still substantial, even in a non-leveraged, non-debt heavy situation. And so what does that mean in practicality? Is that these are not deals that are nearly as sensitive to interest rate movements as, say, publicly traded companies and multi-billion-dollar deals, or early stage IPOs that have been juiced up and moving forward based on cheap money to keep growing. And so the nice thing is that in the middle market and the lower middle market, you have good returns, optimal risk allocation, low leverage, and lots of acquirers looking for opportunities. And therefore, we fully expect that in 2024 and beyond, barring some entire implosion of the economy, will remain very, very strong in the lower middle market M&A space. So that's our thoughts. Going into 2024, capital markets, the M&A markets, it's going to look more normal than it had been 2-3 years ago from a capital perspective. And from an M&A perspective, we actually think it's going to look considerably more aggressive for middle market and lower middle market opportunities that we work with every day. So that's a thought. Hope the week continues to go well for everyone. Keep pushing forward. God bless. See everyone next time.